Welcome to Talk Tickers. Today, we're breaking down Vera Bradley's latest earnings report, which sent the stock on a wild ride.
All right, so let's get right into it. The headline numbers, they tell a super conflicting story, and you can see why it totally confused the market. We've got to unpack what's really going on here.
So first things first, let's look at those top and bottom line numbers, the ones that drove that initial and then, the final reaction from investors.
So on the surface, things actually looked okay. The company brought in $62.3 million in revenue. That just barely beat what Wall Street was expecting. Hey, a small win, but a win's a win, right?
But here's where the story takes a turn. The real kicker is the bottom line. Vera Bradley posted an adjusted loss of 30 cents a share. Now, analysts were looking for a loss of just 11 cents, so this was a huge miss. We're talking a negative surprise of almost 173%. Ouch.
And this is where it gets really fascinating. Look at the market's reaction. Total whiplash. That huge earnings miss, it sent the stock cratering, down about 14% before the market even opened. But then, by the end of the day, it had completely flipped and closed up over 8%. So what on earth happened?
Well, what happened was management. Management's story is what turned the tide. They got on the call and pointed everyone toward their big turnaround plan, which they've branded Project Sunshine, and that's what gave investors a reason to be optimistic.
Okay, so this Project Sunshine, it's built on 5 key pillars. And honestly, it's a pretty ambitious, kind of throw-everything-at-it approach. They're trying to fix it all. Brand identity, how they get products to market, their entire digital ecosystem, their outlet stores, even just the basics of how they work. This is a massive undertaking.
And the executive chairman, Ian Bickley, he was really clear about something. This isn't a total rebrand. He said they're moving to recapture our joyful, authentic DNA. Basically, they're going back to their roots, focusing on what made them famous in the first place. Heritage, cotton, and all that color.
And here you can see the plan in action. They're actually bringing back classic products, like the Original 100 bag. And get this, management says it's really resonating with Gen Z. They're also hitting social media hard to attract those younger buyers, creating buzz with collaborations, like with Anthropologie, and just getting way smarter about managing their inventory and promotions. Okay, so that's the optimistic story from management. Now let's flip the coin and look at the market's more skeptical take. Because look, while the plan sounds great on paper, the current numbers, they show some pretty significant damage to profits and a lot of pressure on the balance sheet.
Remember that massive earnings miss? Well, it was driven by almost $10 million in one-time charges. You had a $5.9 million inventory write-down and a $4 million media credit write-off. And these two things just absolutely crushed their gross margin. I mean, it dropped a staggering 1,240 basis points. To put that in perspective, it went from over 54% last year all the way down to just 42%.
And this right here really puts their struggle into context. The broader market, the S&P 500, is up. The retail sector itself is up over the last year. But Vera Bradley, their stock has been absolutely decimated, down over 54%. So they are really fighting an uphill battle against some serious underperformance.
So it all boils down to a few key questions for any investor, right? First, can that clean gross margin, if you strip out the one-time charges, can it actually hold up? Second, is the balance sheet strong enough? We're talking just over $10 million in cash, and they've already drawn $10 million from their credit line. Is that enough to get through this? And maybe the biggest question, can they pull off this super complex plan while their revenue is still shrinking? All right, so you have management's sunny outlook on one side and the harsh financial reality on the other. So where do we land? What's our call on VRA?
It really is the central question, isn't it? Do you bet on the turnaround story, or do you focus on the very real risk that they can't pull it off? It's that classic battle, a compelling story versus some pretty tough financials.
For our part, we're calling it a market perform. That lines up with the current X rank, which is a #3, basically a hold.
And here's why. On the plus side, Project Sunshine makes sense, and those early signs with the heritage products, that's genuinely encouraging. But on the negative side, you have that severe pressure on margins, a weak balance sheet, and just a huge amount of execution risk. So the potential for a successful turnaround is there, for sure, but it's balanced by some serious near-term headwinds. The company's credibility on profits took a major hit this quarter, making this a classic show-me story.
Okay, but before we wrap up, we've got our outrageous but plausible trade idea. Now, this one is for those of you with a higher risk tolerance, but it could really pay off if Project Sunshine actually works.
So the idea is a speculative long position. The thesis is simple. You're betting that Project Sunshine gains traction faster than anyone expects. The big catalyst to watch for? The results from the spring/summer 2026 collection. That's the first one that will be fully influenced by this new strategy. So you'll want to watch for triggers like sustained gross margin recovery and revenue decline starting to stabilize. Now, the risk is high, no doubt. If they fail to execute, there's more downside. But if they nail it, and this new stuff really resonates with shoppers, even a tiny hint of a positive surprise could cause this beaten-down stock to reprice in a big way. It is the definition of a high-risk, high-reward bet on execution.
And as always, just a quick reminder that this is all for informational purposes. It is not financial advice.